Hello, today I'm back at one of my favorite research websites, microtrends.net, to look more closely at the stock performance of a company we're all familiar with, Coca-Cola. I'm going to click on the Stock Research tab, then enter KO. These are Coca-Cola's trading symbols. This will show me their stock performance for the last 55 years. Now, Coca-Cola's historical chart looks a lot like the S&P 500 video, with very little growth until 1990. Near the height of the tech bubble in May 1998, the stock was trading for about $24 a share. It dropped with the rest of the market, then rose again with the market in 2007 to about $23 a share, before dropping again in late 2008. But it's the most recent run here that I want to look at today. So first, I'll click on the 10-year tab to get a closer look. You can see in January 2009, Coca-Cola traded for less than $16.50 a share, but this has grown to $45.50 today. To find out if this price can be justified, let's click on the EPS and PE ratio tab. We'll first go over a few basics. Price is the cost of a share of stock, and it's determined solely by supply and demand. If you're buying stock, you want the price to be low, but if you already own shares or you're selling, you want the price to be high. Earnings per share is simply the company's actual earnings divided equally amongst all of its outstanding shares. It's a measure of the company's business success. A high figure is good. It means the company's earning a lot for each of its shareholders. Finally, the price-to-earnings ratio shows the relationship between the supply-determined share price and the company's actual earnings. A low PE ratio indicates the stock may be underpriced. It could be a good value. A high PE ratio indicates the stock may be overpriced. Now back to our Coca-Cola chart. When we're comparing, remember, if we're buying, we want the stock price to be low, the EPS or earnings per share to be high, but mostly we want the PE ratio to be low, indicating a good value. So how does Coca-Cola stack up? In March 2007, the stock price was about $17 a share, with a price-to-earnings ratio of 15.84. This would have been a great time to buy Coca-Cola stock. But as I indicated in my S&P 500 video, for the past 10 years, people have been buying up everything without regard to value. As of August 4, 2007, the price of one share of Coca-Cola stock has nearly tripled to $45.50, but the price-to-earnings ratio has increased to 47.89. By all indications, this stock has become severely overpriced. Does this mean that Coca-Cola is in trouble? No. Coca-Cola is a well-managed and stable company that's been around for 130 years. Just looking at this picture is making me thirsty, although I wouldn't pay $30 for a bottle of Coke. Stock analysts might agree that price-to-earnings ratios are a key figure, but would probably say there are many other calculations which should be considered when determining whether or not a stock has become overpriced. One thing is certain. Investors in today's stock market are willing to pay a lot more for a lot less. Throughout the history of the stock market, these are the indications that always preceded a market correction or crash. The only question is, how long can it continue like this, and how far will it fall?